Welcome, crypto enthusiasts, to an enlightening exploration into the dynamic world of cryptocurrency trading. In today's spotlight, we're unraveling the mystique surrounding crypto trading bots. Whether you're a seasoned trader or just dipping your toes into the crypto waters, these automated marvels are revolutionizing the way we navigate the markets. But before we embark on this journey of discovery, make sure to hit that subscribe button and ring the notification bell to stay tuned for more insightful content on cryptocurrency, trading strategies, and the latest in market trends. Our mission is to empower you with knowledge and help you navigate the complex seas of crypto trading. Now, let's dive into the realm of crypto trading bots and uncover how they can be a game changer for beginners looking to harness the power of automation in their trading endeavors. Ready to embark on this exciting adventure? Let's get started. In the fast-paced universe of cryptocurrency trading, staying ahead of the curve is key. And what better way to do it than with crypto trading bots? These automated tools have become the secret weapon for traders, streamlining the process and making the crypto market more accessible for beginners. 1. What are crypto trading bots? Crypto trading bots are sophisticated computer programs designed to automate the process of buying and selling cryptocurrencies on behalf of traders. These bots operate in the dynamic and 24/7 cryptocurrency markets, executing predefined strategies to capitalize on market opportunities. Here's a breakdown of key aspects. Automation and algorithms. At their core, trading bots are powered by algorithms, which are sets of rules and instructions that dictate the bot's behavior. These algorithms are designed to analyze market data, identify trends, and make trading decisions based on predetermined criteria. Execution of trades. The primary function of a trading bot is to execute trades automatically. It connects to cryptocurrency exchanges and interacts with them to place buy or sell orders. This automation allows for rapid execution, taking advantage of market movements in real time. Market analysis. Trading bots use various technical indicators, historical price data, and statistical analysis to assess the market conditions. This analysis helps the bot make informed decisions, such as when to enter or exit a trade, in a fraction of the time it would take a human trader. Types of trading strategies. Trading bots can be configured to implement a wide range of strategies, including market making, placing both buy and sell orders to capture the spread. Trend following, capitalizing on existing market trends. Arbitrage, exploiting price differences between different exchanges. Mean reversion, assuming that prices will revert to their historical average over time. Backtesting, before deploying a trading bot in live markets, traders often use backtesting. Backtesting involves running the bot's algorithm on historical market data to simulate how it would have performed in the past. This helps traders refine their strategies and assess potential risks. Risk management. Many trading bots incorporate risk management features to control exposure and protect the trader's capital. This may include setting stop-loss orders, position sizing, and other risk mitigation measures. Cloud-based versus local bots. Trading bots can operate either locally on a user's computer or in the cloud. Cloud-based bots offer the advantage of continuous operation and accessibility from any device with an internet connection. Advantages: efficiency. Bots can analyze market data and execute trades at speeds impossible for humans. Emotion-free trading. Bots operate based on predefined rules, eliminating emotional decision-making. 24/7 trading. Bots can operate around the clock, taking advantage of opportunities in different time zones. Challenges and risks. Technical issues. Bots can be susceptible to technical glitches or malfunctions. Market volatility. Rapid and unpredictable market movements can pose challenges for bots. Over-optimization. Overfitting a bot's strategy to historical data may result in poor performance in live markets. Understanding the intricacies of crypto trading bots is essential for traders looking to leverage automation in their cryptocurrency trading strategies. It's important to choose a reputable bot, carefully define trading parameters, and continually monitor and adjust strategies based on market conditions. 2. Why use crypto trading bots? 24/7 trading. Unlike humans, bots don't need sleep. They can execute trades 24/7, ensuring you never miss a lucrative opportunity, even in different time zones. Emotion-free trading. Bots operate based on predefined rules and algorithms, eliminating emotions from the trading equation. No fear, no greed. just pure logic. Backtesting and strategy implementation. You can backtest your trading strategies using historical data, allowing you to refine and optimize your approach before risking real capital. 3. Types of crypto trading bots. Market-making bots. These bots place both buy and sell orders to profit from the spread between bid and ask prices. Trend-following bots, designed to identify and capitalize on prevailing market trends. Arbitrage bots exploit price differences of the same asset on different exchanges. Mean reversion bots, based on the assumption that asset prices will revert to their historical average over time. Number 4. How to get started. Getting started with crypto trading bots involves a step-by-step process. Begin by researching and educating yourself about cryptocurrency markets and trading strategies. Choose a reputable bot that aligns with your goals and ensure compatibility with your chosen exchange. Create accounts on the bot platform and exchange, deposit funds, and connect the bot to your account using API keys. Clearly define your trading strategy and consider backtesting it on historical data. Start with a demo account if available to practice without risking real funds. Regularly monitor your bot's performance, adjust strategies as needed, and implement risk management practices. Continuous learning and staying informed about market trends are essential for successful bot trading. Number 5. Risks and considerations. Market volatility. Cryptocurrency markets are highly volatile, with prices subject to rapid and unpredictable changes. Trading bots may struggle to adapt to extreme market conditions, leading to unexpected losses. Technical risks. Glitches, software bugs, or connectivity issues can occur, impacting the performance of trading bots. Technical failures may lead to missed opportunities or unintended trades. Security concerns. Granting API access to trading bots poses security risks. If not properly secured, API keys can be compromised, potentially leading to unauthorized access and fund loss. Over-optimization. Over-optimizing trading strategies based on historical data may lead to poor performance in live markets. Strategies should be balanced to avoid overfitting to past market conditions. Lack of human intuition. Trading bots operate based on pre-programmed algorithms, lacking human intuition. They may struggle to adapt to unforeseen events, news, or market sentiment changes. Downtime risks. Technical issues, server downtime, or maintenance periods on either the bot platform or the exchange can hinder trading operations, causing missed opportunities or delayed responses to market changes. Unforeseen market events. Black swan events, regulatory changes, or macroeconomic shifts can impact cryptocurrency markets unexpectedly. Trading bots may not be equipped to handle such unprecedented events effectively. Inadequate backtesting. Reliance on inadequate backtesting may lead to the deployment of suboptimal trading strategies. Traders should conduct thorough and realistic backtesting to assess strategy viability. Dependency on market conditions. Certain trading strategies may perform well only under specific market conditions. Traders should be aware of the limitations of their chosen strategies and adjust them accordingly. Emotional impact. While bots eliminate emotional decision-making, traders may still be emotionally affected by automated losses. It's crucial to maintain a disciplined approach and avoid emotional reactions. Regulatory risks. Cryptocurrency regulations vary globally, and changes in regulatory environments can impact the legality and functionality of trading bots. Traders should stay informed about regulatory developments, false promises, and scams. The crypto space is susceptible to scams and fraudulent bots promising unrealistic returns. Traders should exercise caution, thoroughly research bot providers, and be wary of schemes that seem too good to be true. Understanding and mitigating these risks is essential for anyone considering the use of crypto trading bots. Traders should approach bot usage with a clear understanding of the potential challenges and take proactive measures to safeguard their investments. Continuous monitoring. While bots can automate tasks, regular monitoring is essential to adjust strategies based on changing market conditions. As we wrap up our insights into the realm of crypto trading bots, remember that successful trading involves not only understanding the benefits, but also navigating the risks. Stay informed, continuously educate yourself, and approach bot trading with a disciplined mindset. If you found this information valuable, don't forget to subscribe for more insightful content, hit the like button, and click the notification bell to stay updated. Share your thoughts and experiences in the comments below. Your feedback matters. safe trading, and until our next exploration, happy investing.